After last year, in February, March of last year, where gold just basically took off and just never really had a correction last year. That was really the beginning, the reigniting the bull market. I think the bull market in gold started in 2019, but it kind of reignited it, but it turned it into a new gear. And now this bull market is continuing. And I do not think we're going to have any deep corrections in gold. Any corrections we have now, I think 10% is the deepest we'll have. And I'm not expecting a 10% correction. And any corrections we have should be bought.
This is Little by Little with Andy Schechtman.
All right. Hello, everyone. Really excited for today's conversation. I'm joined by Don Durrett, someone who's, I guess you could say, been deep in the trenches of gold and silver and mining stocks, especially for years. And from what I know of Don, he definitely knows how to separate the hype from the real opportunities. When I met him in Vancouver here recently, he showed me some of his mining share picks and the rationale behind it. So I'm excited to talk about that here today. And we're going to talk about whether we're starting one of the biggest moments ever for mining investors and how to spot the winners before the crowd catches on. That's why Don is here. Don, it's great to have you, brother. Thanks for coming. And let's just get right into it. Before we dig into mining share specifics, I'm not going to let you off that easy. And I want to step back and ask you a bigger question. With the U.S. becoming a net importer of gold, something I've focused on a lot lately, and the BRICS, something I've focused on a lot for the last 4 years, pushing towards a commodity-backed trade settlement currency. We know of one called the unit already. Do you think we're witnessing a slow remonetization or reintegration of gold into the monetary system behind the scenes?
I do. I think that it's actually started here in April, believe it or not, I think. When Trump did his Liberation Day, I think that was kind of the trigger for basically Trippen's dilemma basically popping and the von Mises bubble popping, both of them simultaneously. They've been building for years and years and years. When we had the great financial crisis in 2008, I thought maybe that was it. But then they went to MMT and basically have been kicking the can ever since, managing interest rates, managing liquidity, thinking that was their solution. Janet Yellen said in 2017, she doesn't expect another financial crisis in her lifetime.
Famous last words.
They're drinking all the Kool-Aid of MMT. And so we've been following this, 20 years plus for both of us. I mean, I've actually been a gold bull since 1990. I was buying gold stocks in the 90s when everybody was laughing at me, right? Because I could see it coming. I saw it coming really, really early. In 1985, I told my dad, I said, what Reagan's doing here with these budget deficits isn't going to work. This is going to cause a problem. And it's been the same way since then, the mid-'80s. We basically been printing money, pretending that we can get away with it. And
yeah, I agree. You're spot on. I've been doing this since 1990, so we share a very similar frame of reference. And maybe that's why much of what you talk about resonates with me so much.
I want to answer your question, though.
Yeah, well, pardon me?
I want to answer your question.
Oh, please, go ahead. I'm sorry.
I was just leading up to it. Sometimes I can just talk like you, just talk and talk and talk.
Yeah, that's my problem.
Right, so April 2nd, Liberation Day, all these factors basically coming to a head. Gold went from the first week of April, it actually traded below 3,000, and then it traded 3,500. Three weeks later, that was a 35% move in 3 weeks.
Right.
Gold's basically trying to tell us something. And I've said that what I think is happening here in April is that gold is changing its colors. It's changing how people think about it. It's changing how it impacts the global economy because there's no place else to go, really. Where do you hide? Can you hide in real estate? So housing's up, which we talked a little bit about that. I couldn't believe it. We're at all-time high today, 330,000 for average home price, and that people are trying to place to hide. That's the reason why they're running. Bonds. Can you make money in bonds? So everybody's hiding in short-term bonds because they're afraid of long-term bonds, right? Stock market. It's at 5,500, but it's ridiculously valued, and everybody knows it. So we're going lower, and so gold is like the only place to hide. So I agree with you. I think that it's finding a way. Gold is right now trying to find a way of integrating somewhat in the financial system. We don't know how it's going to integrate in. One way we know it will integrate in is through investors buying it and holding it as a way to save their wealth, if you will. And I think that is going to pick up. I've been saying that the people that are going to buy gold and silver don't even know they're going to buy gold and silver because they don't own it now, and they've been comfortable owning these other assets, their house, stocks and bonds. They've never really thought, I need gold. But soon they're going to be watching TV and they're going to go, uh-oh, suddenly the light bulb is going to go on. So the people that are going to buy gold and silver don't even know it yet. So yeah, so this reintegration into the economy, we don't know exactly how it's going to unfold, but I think we both know it's going to play a much bigger role. I have to keep raising my targets for gold because of this situation, that gold is becoming more important. And yeah, this year especially, but in April, but this year especially, the way that it's ripped since January, 2,600. We started the year in January. It's just been flying, 2,600 to 3,500. That's quite a rip. So when you see that kind of a run after last year, I'll stop here to let you ask a question. After last year, when February, March of last year, where gold just basically took off and just never really had a correction last year, that was really the beginning, the reigniting the bull market. I think the bull market in gold started in 2019, but it kind of reignited it, but it turned it into a new gear. And now this bull market is continuing. And I do not think we're going to have any deep corrections in gold. Any corrections we have now, I think 10% is the deepest we'll have. And I'm not expecting a 10% correction. And any corrections we have should be bought.
Yeah, you when you say this, two thoughts come to my mind. The first is, it seems as though the smart money, the central banks in particular, have really drawn a line in the sand, kind of making the delineation that gold is not a commodity, it's wealth. And it's wealth that has outlived everything the world's thrown at it for over 5,000-6,000 years, from wars to hyperinflation to massive Great Depression to pandemics to everything. And I think things are coming full circle. But to your point, our mutual friend Rick Rule continues. I just did an interview with him the other day for his Rule Symposium here in Boca in July, and we do a pre-symposium interview. He interviewed me, and again, he talks of 0.5% allocation across the entire U.S. financial matrix of precious metals and metal-related equities. To your point, those people who will buy it will not even know that they are going to buy it here today. And that's why so few people really succeed in investing, is that they follow the herd rather than get out in front of it like the people that have been following you. So I think both of those comments not only are insightful, I do agree with both of them. I've been following mining shares for a very long time, and Rick has been a good friend of mine, and for over 20 years, I have followed him and his work in particular on mining shares, which has expanded my mind. And yet they're still confusing to me. So for someone new to investing in mining shares, if you could offer one piece of advice, just one, if you could offer someone just one piece of advice for them to avoid the major mistakes in mining shares, what would that be?
Don't buy exploration stocks, just avoid them. But you can't do it with one. I mean, that would be my first thing. Just don't buy any any explorers.
Are there any explorers that ever turn out to be that diamond in the rough, or are they just so few and far between that it's really not worth the effort?
the thing, it's about opportunity. So the opportunity is basically in really quality development plays and then quality producers. The risk reward is so much better in those two buckets that there's no reason to delve into the exploration plays. The exploration plays are really difficult, high risk, and they're few and far between. You're usually like 1 out of 10, 2 out of 10. And we're trying to get big alpha in mining. That's why we're doing it. And getting a big alpha in exploration plays is very hard. The reason why is it takes a long time to drill these plays out, takes a lot of money. You got dilution, you're waiting, you're chasing, basically what you're doing is chasing drill results. Now I do it. I've been doing this for a long time, and timing is everything in exploration. You want to get in early, and they have to be somewhat obvious. You have to have a really high expectation that you're going to make money. If you don't have that, you sweat. But most people that go into this, they think exploration, they don't realize the risk reward isn't there. Whereas right now, producers are cheap. And when you can get producers cheap, your risk reward is so much better. For instance, if gold's going to go to 4,500, which I think it will, that's kind of my target. If gold's going to 4,500, Newmont's a 3-bagger. The biggest miner's a 3-bagger. That means 400% return, or 300% return, 4x. If you're going to get that kind of return from Newmont, what are you doing playing around with exploration plays? It doesn't make sense. The average producer is going to be a 5-bagger, the average. And if you pick well, you'll even do better than that. And then developers, but that gets a little more complicated on how to choose which developers you want. Their upside is even higher. So I have too many explorers. The reason why I do it, I kind of do explorers kind of as a hobby. I want to understand them. I want to own them. But I have like 8% allocated out in exploration. But what I've done is I focus more on optionality plays. So like Free Gold Ventures, I mean, it's an exploration drill story, but they have 20 million ounces in the ground. And it's valued at $10 an ounce in the ground. So it's more of an optionality play, and then they can find more. So I like optionality plays on the explorer side, but I will buy some cheap. Like I bought Oh My Gold when it was like less than 10 million. Some of these stories, they're very obvious, but what I do is I'll sell them. They go up 2x, 3x, and I'll get out. But on the whole, yeah, that's the biggest one. Avoid exploration, focus on quality producers and quality development plays. And what I use for development plays is I have these check boxes. And I've learned that if they don't check all the boxes, just don't stay away. Only focus on the ones that check the boxes.
It's funny. I think you and I think very similarly about a lot of things, because the question that I had written down, I give a lot of thought to the questions that I'm going to ask people, and you answered it already. I'll just read it to you because it's kind of silly. I said, now zooming back out, are we staring at a final once-in-a-generation boom for mining shares, and most people don't even realize it? So I guess your answer to that is yes, most people don't realize it. Let's tweak it a little bit and say, what would trigger people waking up and realizing it? What is it going to take for people to wake up and see this?
Yeah. So I'm going to answer that two ways. I want to elucidate a little bit on what you said. Is this a once in a lifetime? I actually, when I got into this, I thought of it as a one-time trade, a one and done, because the reason why is because mining goes in cycles, long cycles. You can wait 5 years, 10 years, 15 years before you get it. 1980, we had 1980 or 2011. People had to wait 20 years in between. And now we're waiting again. Now we're almost to 13 years. So you have these big gaps for when you make money. And I thought, this is going to be a one-time trade. I'm going to get in, I'm going to create a portfolio, and then it goes to the top and I'm going to get out. So in 2011, my gut feeling was it's too early to sell. This isn't it. And when we get a bull market, this once in a lifetime bull market, it's not going to last 6 months. It's going to last 2 to 3 years. It's going to be an extended bull market. And that's when that'll be the fun. For me, I plan on selling to the top here. This is a once in a lifetime deal because it's cyclic. It'll go up and it'll go down. So you might be waiting. Like this thing, we don't know what it's going to top out at. 5,000, 7,000, 10,000 gold. But when it does that, there's a real good chance that we cycle down again. And so I don't want to, I've been building this portfolio for a long time. So I plan to sell to the top. Now, what's going to trigger that? What's going to create the mania? And for me, it's very obvious. What's going to do that? All we have to do is look at history. So the only time that the miners do well is when the stock market does poorly. So you have the 1930s, homestake mining. Everybody knows about that story. It was a leader in stocks in the 30s, and people made lots of money in homestake. And then the 1970s, people made a ton of money. I mean, if you go back and look 1979 to 1980, there was a lot of 50 and 100 baggers. And again, the stock, and it goes to gold outperforming the stock market. So if you compare the price of gold to the S&P 500, as it shrinks down, I think it's going to go 1-to-1, 4,000 gold, 4,000 S&P. As it goes down, and when gold is outperforming the markets, that's when you're going to get this movement into the miners. So it's basically a fear trade. And I've been saying silver's not going to break out because silver's a proxy to gold. And the only time people are going to buy silver is when it is a proxy to gold. And it's only a proxy to gold when you have a fear trade. People are that's when those people go out and say, okay, I want to buy some silver. I want to buy some gold. Well, I can't really afford gold. I have $500. I can buy silver. And so this is how you know there's a fear trade. So there's going to be two things that happen. And the one we're really getting really close to, and that's the S&P 500 rolling over. So right now we're in this 5,000. 5,500 is the correction level for the S&P. That's 10% down. And isn't it interesting? We're just above it, right? They always do this. They get right above these levels. 5,000 is bear market. And so we're in this danger zone from 5,500 to 5,000. Once we go below 5,000, that's the sell zone. That's when the fear trade starts to ignite. And when the fear trade really ignites, and what the fear trade is, it was really interesting because I heard it today. They said that the retail investor has stolen the market. It was the institutional people that were selling. Well, it's the retail crowd that creates the fear market. It's the retail crowd that basically says, I don't want to own stocks. Because the retail crowd, those are the ones that are like, I'm out, right? It's basically an individual decision. They're like, I'm out. So when the retail crowd does not want to own stocks, that's a fear trade. Now, the other thing I wanted to bring up today is this idea of market tops lasting a long time. So people don't realize this, but when you get a market top, and we haven't had one since like 2000, it's been 10 years since we've had a market top, and then things were, but you get a market top and you turn into a bear market, you're going to wait to get back to an all-time high. It could be 5-10 years. And so when these bear markets begin, once you get into one, like 1 or 2 years, nobody wants to buy stocks. So we had, the big one is like 1929, right? So we had a market top in 1929. We didn't have a nominal high until 1954.
Yeah, look at the Nikkei, same thing. It topped in 1990 or so, and I don't think we've maybe touched it for a second a few months ago, and it's back off again. That, to your point, it can take a whole generation.
Yes. I have three other ones people didn't, because I think we're getting ready to have another one of those. 1966, the market high in 1966. You didn't get a new high, nominal high, until 1982. And then in 2000, after the dot-com bubble, you had to wait until 2006. And then from 2007, the high in 2007, you had to wait all the way till 2013. So a 5-year gap. We got two this century. And so we might have just already had the high in the S&P right around 61.50. We might be waiting 5 years before we get back there. And so my point is that if we go into a bear market below 5,000 and people start jumping off the boat, that is when people will go into miners. That's what you saw from 2000 to 2011. People were going into miners because it was hard to make money in stocks. And that fear trade, that's what creates the mania into the miners. And that's what I'm expecting to happen. The other thing that's amazing is gold. Usually when you start a bull market, you don't start at an all-time high. The HUI, which is the miners index, it really isn't broken out. I mean, it's trying to right now, but if you look at it, the value of the miners are basically still very highly undervalued, right? But gold is like an all-time high. You have this big disconnect, so that has to tighten. So the miners are going to actually rip really fast, but when they rip really fast, they're going to still have a lot of legs. That's why we're going to get a 2 to 3 year run. It's pretty amazing. I mean, okay, let's go back to the last bull market. The last bull market was 2000 to 2011. When in 2000, price of gold was $250. So that they were starting at a very, very low level, so they could ride gold up for 10 years. It went from 250 to 1935. So we had that long one. Now this one's going to be a little bit more condensed. I think it's going to be at least 2 years, but it could go 3, 4, maybe 5. But it's pretty amazing. This is a very unusual situation. This was what I thought was going to happen when I got into the miners, that you were going to have the bond market, and we can get into this, if the U.S. bond market basically fail. And that's what I just wrote my newsletter, and that's basically what I wrote about, is that the U.S. bond market failing. People are going, that can never happen, Don. Well, that's the only reason I own gold miners, is because it has to fail. And we can get into that. It's not can, will, won't. It has to. I mean, that's economics. It's economics 101.
Yeah, it seems that way. Who would want to hold a treasury of a country as indebted as we are, with the instability we've seen in the treasury market, the sanctions and the confiscation risk? And I think that's one of the reasons we're seeing central banks favor gold as a tier 1 over U.S. treasuries. It certainly makes sense to me. Speaking of, where, your son comes to you and says, Dad, I'm young, I want to start putting away money. Where does physical gold, fit in your recommendation to someone beginning this journey versus mining shares? Are they in different parts of the financial pyramid? Is one an asset to hold, like physical metal, and one is one to speculate on, like mining shares? How do we separate the wisdom of both asset classes to someone who's just learning about this field of precious metals?
Yeah, so I started doing this. I started buying juniors in 2004, and when I did that, I tried to find a book on the market, and I couldn't find one, and that explained to me how to analyze like a junior miner. How do you know if a junior miner is worth buying? I mean, I literally couldn't find a book on the market, and I asked one veteran, Bob Chapman, and he said there isn't any. So I'm a writer. So after I learned how to do this, I wrote my own book. And when I wrote that book, I came up with this idea of a pyramid. And you just mentioned this in one of your things. And it's basically a pyramid approach where the foundation of the pyramid, the bottom of the pyramid, has to be low risk assets. And that's where you buy physical. So I always tell people not to buy any mining stocks until you buy physical. Now you can do physical gold or silver, but I recommend 1,000 ounces of physical silver before you buy a single mining stock. So currently that's about $30,000, $40,000. So it might take you a while to do it. But I remember when I started in 1990, I did $500 a month. So you just do it every single month, and you stack that physical silver until you get 1,000 ounces. Or you can say maybe you can do both, gold and silver. You can prefer gold and do gold. But that's your foundation. That's your starting point. So anybody that's starting out, they should just get their piggy bank full of physical. That should be number one before you start speculating on alpha. Then I also, in the book, I basically say, look, don't jump right to the juniors or the mid tiers. Make sure you get that foundation in. So I like majors. You can do mutual funds, ETFs. So I did 3 mutual funds, which has done fabulously well for me. And I've done, I think, 6 ETFs. So between the physical, the mutual funds and the ETFs, that's my foundation. And then in the next one is your majors that have a lot of upside, and in your mid tiers. And that's where I want to be overweight. And if you get that foundation in, then you can go ahead and go to town on development plays and explorers, because you got that foundation set there. But I think Anybody that doesn't have 1,000 ounces of physical silver and they have other investments, they're making a mistake. They need to get that 1,000 ounces of silver. And the reason why is because silver's going to $100. So that's 100 grand. That's 100 grand right there. That's a good piggy bank. And the thing that's good about it is not only do you have a big piggy bank, but it's not going to go down in value. It's only going to go up. And you don't want to spend it. It's your piggy bank. And remember when we were kids, we were like, we got to have a piggy bank, right? This is the adult piggy bank. It's your own physical piggy bank. But yeah, I'm a big believer in that. And that's the starting point.
Yeah, we call that asymmetrical risk reward, the lowest downside and best upside. I use that phrase when I speak of silver. I think it is a generational opportunity. And you mentioned something that I've spoken about for years now. When I started this company with my father in 1989, 1990, he told me the one rule would be to accumulate something every 2 weeks, gold or silver, or he would fire me. And even though he won't fire me any longer after 35 years, because I've owned the company outright for over 2 decades, I will tell you it's the best advice that I've ever been given, the best gift my father ever gave me, the gift of learning the laws of compounding, of time, of effort, of energy. It's not just compounding of interest that they speak of as learning the laws of compounding. It's also effort, whether you're in a gym working out or investing every 2 weeks, like you say. It's amazing how the compounding of time working in your favor instead of against you is a blessing. So I'm glad that you said that. And I do agree with you as well that you must have that solid foundation. In fact, my business started on Swiss investments. And the Swiss have had a philosophy for over 300 years where the base of your pyramid are things that are stable, low growth, low risk, but allow you to not move backwards. And then everything you build on top of that, the speculation gives you the opportunity to expand your pyramid. So solid advice there for sure. Now, when you look across the entire mining sector right now, juniors, mid-tiers, majors, royalties, where do you personally see the very best potential for outsized returns over the next few years? But let's add into it a little bit of the asymmetrical equation, which would be, yes, we want those returns, but we don't want to risk the farm. So for someone looking to potentially add a little bit of fuel to their performance, while at the same time not losing sleep every night, staring at the phone every 30 minutes to see where their stock prices are, where would you tell someone to position themselves right now?
Well, first of all, the one thing about mining stocks is they provide high alpha, but you don't get a high alpha without high risk. And one thing that people do is they think that these stocks have less risk than they do. So you have to understand no stock is a slam dunk. They all have high risk. That said, there's only about 15 silver miners with market caps over $100 million. It's a tiny little basket. And of those 15, basically you can pick 8 or 10 of them. And I have a group of stocks I call the Mormons. They're the prettiest girls. You can marry all of them. And so the silver miners right now are unbelievably cheap. People are very lucky that they can actually buy them when silver hasn't broken out yet. I don't consider silver a breakout until it gets above $35. So silver hasn't broken out. I mean, its all-time high is $49. It's $68 when you apply inflation adjusted to 2011. It's 49 plus inflation is 68. So the all-time high is really $68 in my opinion. And you could even say it's higher if you go back to 1980, but at least 68. And so if you value these miners at $68, I mean, that alone, they're crazy cheap. But then I value them at $100 and they're all unbelievably cheap. So the alpha in the silver miners is pretty amazing. Now, the tricky part with investing in the silver miners is that you don't want to over allocate because you're taking too much risk. And so that's where people have to be careful how they do their allocations. And my book explains how to think in terms of how you do your allocations. Like me, I don't like to do more than 1% of my total cost basis in a single miner. And most people are like, Don, that's not enough. I got to do more. But for me, I'm more comfortable. I like to take the emotion out of it. Like if I put 1%, I mean, the odds of me, I'm only putting 1% in the high quality companies. I'm putting 0.5% in high risk companies and sometimes less than 0.5%. So depending on the risk of the company, I do like 0.25, 0.35, 0.5, 0.75, 1. But it's really rare for me to do more than 1%. The only time I do more than 1% is if it's an ETF or if it's a mutual fund. But an individual company, I'm not going to do more than 1%. And that just gives me my comfort level. Now, the problem is, if you only do 1% in 15 miners, that's only 15% allocation. It's like, that's not enough. I want 60% of my money in silver miners. Well, what you can do then is you can do the silver ETF. So there's only 3. So you can buy all 3 of the silver ETFs. We have SIL, SILJ, and SIVR. SIL, yeah, I think it's SIVR, the new Sprott one. It just came out. So there was only 2. Now there's 3. So you can do those.
SILJ being the juniors?
Yeah. Well, they call it the juniors, but it's kind of misleading. It's more mid-tier because they can't do mid-tier. The thing with the juniors and the silver miners is they're really, really tiny. So they just don't have enough liquidity. They basically own the whole thing, and they move the price around so much. So since there's so few silver miners, they can't really, a lot of these juniors, they don't include in their portfolio. It's just, they're just too small. And then they'll allocate more to the upper end, but they call it SLJ. So a little bit more. They try. The SILJ does perform better than SIL because it does that. Not as leaned towards the bigger cap names, but there isn't any big caps. So I think there's you got Pan American Silver, which is now a gold mining company, and then you got Hecla, and you have Coeur. Those are really the only somewhat, big cap silver miners, and they're not really big cap. They're still kind of mid-tier. Hecla, I suppose, in Coeur, but you have 3 somewhat large names, but most of them are not very big. It creates huge leverage for us as investors because they're small companies, and small companies have, massive upside potential. Okay,
I know you've been asked this question, Don. Why wouldn't a guy like Elon Musk or Warren Buffett just buy it all up? Why wouldn't he just buy it all up, buy the whole sector?
They haven't figured it out yet. They don't have belief. They don't. The reason why me and you understand gold and silver is because we look at it from a macro frame of mind that gold and silver are going much, much higher because of reasons. And they don't get it. It doesn't sink into their head. If they got it to sink into their head, these guys would be buying the heck out of these 10 silver names. If they had a strong belief that silver was going to $50 in the next 12 months and $100 in the next 24 to 36 months, you betcha they'd be buying it. But they don't have that belief. Now, I've had that belief. Remember, 85, 90. I've been to a gold bull like 91. My grandfather gave all the grandkids $10,000 in 1991. I took that $10,000 and bought a gold mutual fund. I've got it for a long time. Now, for me and you, we've been following this stuff like a hawk for 20, 30 years. 30 years, I think we can say. And the one thing that we've been following like a hawk is the U.S. economy and the choices that we're making and how that leads to the future. But I wanted to talk a little bit about the bond market because I think this is really important. Right. So the bond market, the U.S. bond market, they talk about this idea of this milkshake theory. The dollar is basically is going to be the last man standing. It's going to go up in value. The DXY is going to go 120, 130, 140. The problem with that thesis and that theory is that it's based on the U.S. economy remaining dominant. So the U.S. economy has been dominant since 1945. As long as it's dominant, yeah, the milkshake theory totally holds water because if everybody's inflating, everybody's dying, the U.S. has the dominant economy, so it's going to be the last man standing, right? Simple thesis. But if the U.S. economy stops growing and starts regressing, and all the liquidity problems start blowing up, and the Fed cannot basically bail out all the regional banks, and banks start closing, and the U.S. economy gets into this spiral, this downward spiral where it can't get out of it because they can't print enough money to get us back on board, and things keep spiraling downward. And under that scenario, people are going to be dumping dollars, all the foreign money. That I don't want dollars. The U.S. economy is going down the toilet. I don't want it. They're dumping dollars. They're dumping bonds. Under that scenario, the dollar goes down. So the dollar, I don't think there's any surprise here that the dollar's under 100 here, because what Trump's doing with his tariffs is he's basically making the U.S. economy unstable. It's becoming destabilized here, and he's basically pushing it to the limit. And I think he's going to break something really quickly. And once things start spinning, it's going to be really, really difficult to turn this back. Now, going back to the bond market works only one way, and that is there has to be buyers. We can't just print money when you already have inflation. Now, we're already borrowing 106 on average. If you take $2 trillion divided by 12, it's $166 billion every single month. Who's going to buy the 166? Now, if you have a recession, that jumps to $200 billion every single month. Who's going to buy the $200 billion? Buffett wants the banks to go back and start buying them. He wants to change the rules so the banks can start buying the bonds. Well, the banks are losing money on bonds. Maybe they'll buy short term. Maybe that's part of it. They're probably going to try to find other ways, but they're going to try to. But the bottom line is there's not going to be enough buyers, especially when you're in a recession. So you go into recession, not only will there not be enough buyers, but you're going to have more foreign sellers. And it comes down to this very simple thesis is this. And the thesis is this, is that if there aren't enough buyers, the Treasury, the U.S. Treasury at a certain point has to go to Congress and basically say, we can't borrow what we need. And now, it's really interesting that Powell and Buffett are actually talking to each other. They're like buddy-buddy. I'm hearing they're having like meetings and stuff like that, having lunch, talking. And it's really interesting because those two guys are like working together to basically manage the economy, manage the thing. Well, they're going to realize at a certain point, now it's not going to happen overnight. It's going to take a little bit of time, probably 2 years. But once it starts to break down, everybody will know it's breaking down. And how it will be breaking down is the Fed will have to start monetizing the debt. As they do that, their balance sheet will start expanding. And that's the beginning of the end. Because once that happens, investors are going to go, this isn't working. They're just printing money. Inflation keeps going higher. We start having stagflation. Now, some people in the MMT crowd are going to go, oh, this is fine. We can just keep printing our money and nothing to see here, right? But the smart money is going to go, they're in a downward spiral. They're in a death spiral. And once the death spiral starts, at that point, Buffett has to go to Congress and say, we can't borrow what we need. And that's it. That's when you get a reset. And this is what gold is sniffing out. This is the unwinding of the Triffin dilemma. This is where basically we give up the reserve currency. Can't do it anymore. Because Triffin's dilemma basically says that if you hold the reserve currency, your economy is going to go downhill. It's just a matter of time. Because you're playing at a disadvantage because your currency is too strong. You're the reserve currency. Everybody's using your currency. You can't compete. And that's exactly what has happened. We can't compete. Now, Trump goes, well, we're going to bring back we're going to onshore these manufacturing jobs. But the problem with that is it creates inflation and our standard of living. And then it's timing. But basically, we've waited too long. Dalio just came out and said it's too late. He tweeted last night, it's too late. And I agree, it's too late. It's too late to fix this Triffin's dilemma, our problem. So we've been living beyond our means since 1980, believe it or not. That's how long we've been living beyond our means. Now, living beyond your means is what von Mises said in the 1950s. He basically said, if you want to live beyond your means by using debt, you're going to create a debt bubble, and that debt bubble is going to pop if you don't pay back that debt. And that's what we've been doing. We've been living beyond our means. So our standard of living is it's not accurate, right? It's not. So that has to give. The U.S. is going to get rug pulled here. But what people don't realize, and I've seen, like me and you, we basically can see it coming. There's nothing going to prevent it. And this rug pull that's coming is, and I don't like to even say this sometimes in some of these podcasts, but this rug pull is going to be so impactful, if you will, that when you combine the economic rug pull with the mainstream media stop doing their job, and our politicians basically bifurcated, completely split apart from each other, where they don't really talk to each other, and then that political chasm has spread not just to Washington, but it spread to all of America. It spread to our justice system, for instance, our legal system, right? So America is fragmented already. And so once that economic rug pull comes, it's like Katie bar the door scenario. It's like, how do we get out of this hole? And that's why you want to own gold and silver. That's kind of the train track we're going down. And that train track only leads one way, to a wreck. It's like I said earlier in this podcast, this isn't a probability. This is kind of a certainty. This goes back to, the same thing when the Big Short, when he basically said, this is a certainty, right? Maybe he was 99% sure, but he was pretty darn sure. He actually, I think that quote in the movie was Michael Berry. I think he said that. I do. I think he said it. I think he probably meant it. And that's kind of how I feel about the direction that we're going in. It's kind of a certainty that we're going to have a train wreck here. And people think, well, we're going to kick the can. It's going to happen in 10 years. But I've never seen, and I think you can agree with me, Andy, I have never seen an economy so close to a recession as we are right now. And if you go back to, and I was a little bit too young for the 1981, but 1992, you couldn't really tell the recession. You could tell, right? And then 2007, this feels a lot like 2007, but it's much, much worse. And so, I mean, it's like every single data point is basically screaming, recession's coming. Recession's coming.
To your point, the Atlanta Fed has revised their GDP numbers from a positive 3% to almost a negative 3%, a pretty big swing, which would signal, indeed, we are moving and feeling those recessionary undertones are beginning to take hold, maybe the stagflationary as prices continue to rise. And I don't care what the CPI tells us, inflation is certainly not under control, and in my opinion is getting stronger. Also, to your point about the treasuries, we have $6 trillion coming due next month. $6 trillion. $28 trillion coming due by 2028. In the 3 years between now and then, we should take in roughly $15 trillion in tax revenue. That leaves us a good bit short, almost half. And that doesn't take into account all of the deficit spending between now and then. These are all, I think, supporting your thesis. Triffin's dilemma, for sure. This seems indeed where we have lived well beyond our standard of living has been increased, or certainly beyond what we should be living. And you're right, Triffin's dilemma is what has kept goods cheap, has kept interest rates low, has kept asset prices high. This would be a massive shock for the people in this country who really don't understand this, but will witness it in real time if indeed these things play out. You mentioned von Mises. I always think of his statement of a massive expansion of credit, like we've seen at zero bound interest rates and easy money for years and years, is always followed by a massive contraction of credit. And in a system that is addicted to credit, that's a bad deal, especially when you have asset prices so high. So I follow everything you're saying. I agree with it. And the question is, in the back of my mind, doesn't Trump understand this shit too? I know Scott Bessent does. I know Paulo does. So the question is this intentional? Is he trying to reset the system because he realizes we're out of options? And you know what? It just, either you're dumb or you understand that we're out of options and a play must be made, a play to reset the system, maybe tie it to gold. As you mentioned, it's being reintroduced into the monetary system. We've become a net importer. Lots of things, interesting things to ponder for sure. And I don't know. I think it could be intentional. I think this could be done to reset the system. I guess only time will tell. But let's just flip it a little bit, and we'll before we wrap up, we'll leave the audience. I think they already have something pretty significant to think about here. But when you look at everything that's happening, the risk, the chaos, the opportunities, and certainly we've touched on all. We've talked about opportunities, we've talked about risk, and we've talked about potential chaos. Katie, bar the door, as you say. What gives you the most hope right now for investors who are paying attention and are willing to act? And because I think, often we in this industry focus so much on doom and gloom, myself included, but, reality and pessimism, I think, are separated by a very thin line right now. What do you think gives you the most hope for investors right now who are willing to pay attention and willing to act?
Gosh, I hate to be honest here. So I mentioned earlier that I'm a writer. So I actually write metaphysical books. And so what gives me hope is science. We're getting really, really close to science understanding reality. There was actually a tweet. I've known this since 1989, and I'm waiting for science to figure it out. And when science figures this out, the world's going to become a better place very, very quickly. And what that is that everything is basically energy. Everything is conscious, and everything is communicating with each other. It's the way that it works is, this is not my opinion. This is fact. I'm just waiting for science to, some of us know this, but the average person, the average scientist thinks it's not even a thesis. It's basically esoteric nonsense. But there's literally nothing separate. Separation is a lie. Separation is, it doesn't exist. For instance, if we could tell, the thing that's going to get science on the path of basically doing the research on this, right now in science, they don't even study consciousness because they don't even believe it's possible. The average scientist thinks that telepathy is total BS when it's real. And how does telepathy work? Telepathy basically works without any distance. There's no distance. Distance is irrelevant. You're on the other side of the world and you can basically have a communication through your head. Now, how does that happen? It happens because of what I just said. Everything is conscious. Everything is alive. Even air. The air is actually energy. Everything is energy. Everything is energy. Everything is conscious. Everything's connected. Everything's interrelated. And this, when this is the truth that's basically going to set us free, that's going to change everything and give us hope and basically bring us together as human beings, war will be over. There will be no more wars in 10 more years. Now people go, Don, that's impossible. Look what just happened in Palestine and Gaza. Look at what's happening in Ukraine. Look what's happening in Africa. Well, this war is going to be over in 10 years. You're out of your mind. Well, the only thing that will stop war is what I just said. That people go, wait a minute, man, we're connected to each other. We can't kill each other. That makes no sense. So this is really what gives me hope. And what's coming, and I've been writing about this for 20 years, what's coming is a spiritual shift, not a religious shift. It's a spiritual shift. It's just an awakening of who we are. And that's coming soon. And people don't know this. I know it's coming soon. I've actually been doing the gold and silver stuff as a hobby on the side to wait, because nobody cares what I have to talk about. All this spiritual stuff that I do, the writing, nobody cares. People don't care. They think it's nonsense. It's BS. So I just wait. I just wait until people are ready. Wait until the truth comes out. And then once it comes out, then I can start explaining how it all works. But before we go here, I want to talk a little bit about resetting the system, because this is actually something that you talk about. Is Trump trying to reset this system intentionally because he knows? No, I don't think so. I think what Trump is doing is he actually has been a pro-tariff guy most of his life. He actually talked about this in the 1980s, talked about how tariffs would be good for the country. So this is something dear to his heart. Trump believes, I haven't talked to anybody, I haven't read any of this. This is my own belief. But I believe that Trump recognizes that he is here. The only reason why he's president is he's here to help, to do something positive. He's not here to basically, be president. Most politicians, they want to be president the first time they run for office, right? I mean, that's their goal. Trump, I think, got into office. Yeah, he has a big ego and he strokes his ego and he likes all that and he likes all the interaction. But I really think that he got into this because people asked him to do it because he thought deep in his heart that America's going down the tubes and someone's got to do something. Now, I was really upset with Trump. I don't vote. I'm not a Republican or a Democrat. I'm not even an independent. I don't fit into any of that, and for various reasons. But Trump, my biggest complaint with Trump in his first time he ran is he ran as a populist, but he governed as a Republican. And what I mean by that is when he ran, he basically said, I'm going to bring the jobs back, which was a populist. In other words, I'm going to help everybody. I'm going to help the middle class. I'm going to help, but he ran as a Republican. He didn't bring the jobs back. When he redid NAFTA, I thought that was a terrible deal. It didn't bring manufacturing back. All he did was reinforce it in many respects. He reinforced globalism. So now this time he's basically trying to get it right, but it's too late. It's too late. He's recognized that globalism doesn't work when you have the reserve currency. It doesn't work. We can't just have free trade. And that's what Wall Street has wrong right now. Wall Street thinks that Trump wants to improve globalism and create these free trade deals like with Japan and Korea. That's not what he wants to do. He wants to keep these tariffs in place to bring in revenue because that's what we did in the 1800s, which he loves. And he said just yesterday, he tweeted, and he said that tariffs are going to be a bonanza for America. He wants to use tariffs to raise money to do two things. He thinks it's a win-win. He wants to fix the trade deficit and he wants to fix the budget deficit. So I don't see it as a reset, but that's what's coming. I think the reset's coming in 27, but 27 plus or minus a year. But I think that by him trying to fix the trade deficit and the budget deficit, it's going to blow up. It's not going to work. They basically, it's too late. They're trying to fix a problem that should have been fixed 8 years ago. He might have had a chance back then when we didn't have inflation. He might have had a chance. But the way that he's doing it is way too aggressive. He needs to do it very subtly, right? Really subtly, one country at a time. One country at a time. The one thing that I said back then, the first time election, look what Reagan did. Reagan, he didn't have these big, combative things going with Japan. He basically just said, look, come build some of your cars here in America, which they did. He was very subtle. Reagan was very subtle about it. But if you remember, Japan started making a lot of cars in the 80s, right? So all Trump had to do was say, look, Samsung, LG, Panasonic, Sony, we don't want you to make all your stuff here, but just come make some of it. Come build a plant. He could have cajoled them into starting to reshore. What I would have done, I would have basically said, 5% of your revenue, right? Maybe 5 to 10% of your revenue has to come out of the U.S. versus your imports. So if you import 100 million, 5 million's got to come out of the U.S. Something like that, maybe 10 million, 5%, 10%, just enough that they have to build a plant here, right? If you say it's a minimum 5%, they got to build a plant. If he would have done that, I think we would have had a chance, but I think it's destiny. I really do. I think it was just destiny that he didn't fix it then when he could have, and now it's too late. And the destiny is what I said earlier about this spiritual shift that's coming. So the only way that people are going to change, is when they have to. That's kind of how people are. It's how we're kind of wired. We only change when we have to. If we're comfortable, we're going to keep doing what we're doing, right? That's just human nature. So you got to be uncomfortable to do change, to get up and move from a state. You live in California your whole life. To get up and just move out of California, you got to have a reason, right? You got to be uncomfortable. And I think that's the destiny of our country. I think the change is coming, which I'm very hopeful for. The change is coming. Now, I'll end it on this last note, is that America, the Constitution, the U.S. Constitution, is the only constitution in the world that's basically based on individual sovereignty. The Bill of Rights we're the only country in the world that has a Bill of Rights where our freedoms are built into the Constitution, right? That is not going away. America is not going to give up our freedom. Once you give people freedom, once they get a taste of it, they're not giving it up. And so when we reorganize America, which is coming, it's going to be founded on freedom. And when you combine what I said about this spiritual shift about how we're all interconnected with freedom, it's going to be a very beautiful outcome, but it's going to take 4 generations. But we're the first generation that puts it in motion. We get to see the beginning of it, but it's going to be very messy. The rest of this decade is going to be really messy. That change, that big push into it, how we have to reorganize everything. And it really comes down to losing our way of life, losing our standard of living, which is going to come, that's the economic rug pull that's right around the corner. So I'll end it on this. If we're getting a rug pulled economically, banks are going to close. It's going to get really nasty. You better have gold and silver. There's one
amongst other things like lead and food and water and batteries and the community. And
yeah,
I mean, that is a powerful note to end on, no question.
There's this acronym, you're not going to make it, right? You don't have any gold and silver, or like you said, guns and butter. And I think a little bit of crypto, you're not going to make it. You better have some.
I appreciate that. And I know that on comfort. I moved from Minnesota after 50 years to Florida. Much of what you say really does truly resonate with me. I do certainly appreciate you sharing your time and your insights. Don, how can people find out more about what you're doing and to look at your mining shares and the way that your macro perspective is shaping your investment ideology?
So my website, Gold Stock Data, and that's for people that already have mining stocks. So it's not a stock picker website. It's more for people that are building a portfolio. And then if you don't own any gold mine stocks, or even if you do, and if you want to start out, read my book. So I have the only book out there that explains how to analyze these mining stocks. And I've updated it many times. I think the 10th edition is out on Amazon right now. And that book is incredibly useful for people that want to understand how to analyze a mining stock, gold and silver mining stock. But thanks for having me on, Andy.
Yeah, Don, I appreciate it, my man. We'll have to do this again. And as the world is very fluid, a lot of these things that you're talking about seem to be happening right here in front of us. So we'll have you on later on in the year, and we'll come back and review. I do appreciate it. I hope that you stay well, and everyone else out there. Thank you for tuning in, and stay sharp, stay curious, follow guys like Don, and hopefully we'll see you all next time. I do appreciate it though very much, Don.
I want to say one final thing, Andy. I really appreciate what you've done over the last few years. You've given a lot of your time for doing podcasts and getting the word out so people understand what's coming. You've done a great job, great service to this country and humanity. So I want to give you kudos for that.
I appreciate that very much. It's been a labor of love, almost over between, I don't know, I lost track, somewhere just south of 6,000 videos I've done since 2019. So, but it's something that has changed my life. And so it's always cool that it's enabled me to get to meet and talk and become friendly with guys like you. So thank you for the kind words. Thank you for sharing your time. And we will definitely do it again. Hopefully I see you at the Rules Symposium down here in July. If not, somewhere down the road, whether it be in New Orleans or in Vancouver, or if you're ever down this way, look me up. But thanks again, Don. I appreciate you, bud.
All right, Andy.
Little by Little with Andy Schechtman.